Now, all that provides a backdrop for Australia, but Australia's economy is much more dependent on what happens in Asia than what happens in other parts of the world. 75% of our exports, quite a lot of them are over here in this other category, 75% of our exports are in Asia. And in a nutshell, I think that means that our focus should be much more on Asia. So I want to talk a little bit about China here. Now, there's no doubt that the slowdown in Europe in particular, but also generally in the developed economies, has slowed down exports in China. You can see it quite clearly there. So there's exports, as you can see, to the European Union. Already talked about the extent of the recession there. So it looks very much to us like that has significantly slowed China's growth rate, although you have to keep reminding yourself that in China, their issue for the last couple of years has been it's been overheating. So part of the reason why it's slowed down is because the authorities took measures to try and slow that economy down, to stop the housing bubble, to get their inflation rate down. It now appears that that economy is going to bottom out at around about 7%. So you can see our forecast on this chart with the economy basically bottoming out at around about 7%. And meanwhile, there's the recovery in the US. There's the recession that Europe's in now. We do have it recovering gradually ahead, although these sorts of growth rates, I think most people would find them fairly dismal in Australia's economy if that was all we had to look forward to, for example. But generally that's a fairly sort of positive background, I think, made more positive by the recent action by the European Central Bank and also, of course, by the Federal Reserve. And the Chinese authorities, as the last point here, have an awful lot of room to stimulate their economy if they want it. They have massive reserves they can use for fiscal policy. They have relatively high interest rates and a fairly tight money market at the moment. So they can loosen up all of those things if they really need to. So again, we're quite confident that China will grow somewhere in the range of, say, 7 to 8% over the next 12 months to 2 years. Pretty good backdrop for Australia. So let's move to the Australian economy and how things are going here. So first of all, I want to say I'm in the half glass full camp, and saying that I'm just going to get a glass of water, which I've cleverly put up the back here. So I'm a glass half full person, not a glass half empty person. And the importance of this is not to be sort of lost. How's Australia's economy travelling at the moment? Well, this is from our latest NAB business survey, very similar to the methodology that Simon's survey uses for here, done across about 500 plus companies across Australia every month. And the sort of lighter coloured lines on the chart here represent our monthly survey. So there's the latest one for August. You can see here it's running almost exactly on a 3% rate of growth, which is about the trend rate of growth for Australia's economy. So yes, there are a lot of differences, but basically the economy is in a pretty good place. It's running about its long-run trend pace. On the labour market, our unemployment rate as of the latest reading was 5.1%. So it's just above the full employment range, 4.5% to 5%. Meanwhile, the inflation rate in Australia at the moment, and I almost exclusively these days look at the underlying rate, sitting right on 2% here, likely to be within the target band right out to the end of 2014. One of my colleagues in Sydney, a fellow called Peter Jolly, lectures in an MBA course that Macquarie Uni runs, and we were talking about some of the sort of theoretical stuff he's teaching his students at the moment. We're talking about internal balance, and Pete and I came to the conclusion that this is about as close as an economy ever gets to internal balance. It's running at trend, its inflation rate's on target, its unemployment rate is near enough to a full unemployment rate. That's an economy that's, you know, pretty much just getting on with its business. It's not too hot, it's not too cold, it's pretty ideal. Now, having said all that, there are huge differences across this economy. So that average economy is, if you like, masking a great degree of variety. One of the things that caught my eye from Simon's presentation was building approvals and how they've just started to pick up. One of the things we've been watching is the construction sector in our NAB business survey. This is the same survey that I just showed you a moment ago, but split up by industries. Construction is held down by residential construction. Engineering construction, which is also in there, is going through the roof, but house building is a much larger proportion of total construction in dollars, so that's holding down our construction. It's the weakest part, so that's the building. Now again, you can see there is a bit of an uptick there. Just as Simon said, I think it's happening nationally. There is a bit more activity, but at the moment it's very, very subdued. It's almost depression sort of rates of growth in the construction sector. And yes, it's true that manufacturing and retailing are both fairly soft. This one here, which we call these days business services, so that's Simon's finance, property and business services, a pretty large employer. Every time you go into one of Australia's big cities or in these regional centres like Wollongong or in Newcastle again, all those office blocks are full of people that work in finance, property and business services. It's sort of level pegging at the moment. It's certainly not growing rapidly, but neither is it going backwards. And then one more thing I should show you on here is this particular sector, which is very important as an employer, household services. That includes health and education, huge employers of labour in this economy. It's growing at a rate which I would call moderate to strong. And in a way, it's because these services sectors are doing so well. That's why the unemployment rate's so low, because they're the ones that the media never want to tell you about. They either want to tell you that mining, and yes, it's strong, mining's growing strongly, but everything else is weak. It's a two-speed economy. No, I'm sorry, it's not a two-speed economy. It's a multi-speed economy. And in saying mining, manufacturing and retailing, you're missing out on the great bulk of where most people in Australia work, which is in the services sectors, which are doing okay. Now, in terms of the outlook, I guess one of the things you can see from this chart is just how strong mining's been. And in the next few minutes, I want to really talk about this in some depth, because this is the key to where Australia goes down the track. Now, the first thing to note is that there is a lot of work in the pipeline. So, you know, the idea that the mining boom is over is just complete and utter nonsense. It's not over at all. In fact, it's got, at a minimum, it's got 18 months to 2 years to run. This particular map of Australia here shows you all of the investments which are currently on the go. These are called advanced projects in the Bureau of Mineral Resources and Energy Resources' list of projects, which comes out every 6 months or so. And as I said, these are all projects that are on the go. At the moment, they add up to about $260 billion. $260 billion worth of projects, which don't peak until somewhere in 2013-14. Now you'll say, well, how come there's all this talk about projects which are being deferred and so on, right? So can somebody name me the big South Australian project which has recently been deferred? Roxbury Downs, right? So have a look at the map. Where's Roxbury Downs? It's not there. Why isn't it there? Because it never made it to the advanced list. It's on another list that, you know, those sort of very talented wordsmiths that the Bureau of Mineral Resources call the less advanced projects list, right? Which is a list below the advanced projects list. And the reason why it's not on there, as every one practically of those projects that you will have heard was deferred, because it's on what I call the wish list, the less advanced project list. And there are a lot of reasons why things are on the less advanced list. It's because they haven't had the regulatory approvals signed off, they haven't had the feasibility studies completed, they haven't been committed to by the boards of the companies that are proposing them, and so on. There are a number of reasons why. So basically what's happened is that those projects on the wish list have been pushed out because of the drop in commodity prices. But don't be fooled into thinking there's not a lot of work ahead here. In fact, there is. But I'm still interested in what happens down the track. Now, this is NAB's own work on the outlook from that less advanced list plus the advanced list. So the advanced list is the, if you like, the dark part, whoops, wrong button again, the dark part of these columns. So that's the stuff on that advanced list. All of this lighter coloured stuff is things that are on the wish list. And we've gone through all of those announcements and tried to figure out what they mean, one by one, line by line, right through the list. And what the best we can come up with at the moment is these little red dots across each column. They show you what the outlook is right now. Now, at the outset, I should say, I think that's pessimistic, because as we go further out here in time, and down the bottom here, for those of you right out the back, this is 2018 out here. I think that if China keeps growing rapidly, we will have more projects added to this list. But right now, most companies involved in this investment are up to their ears in investing in this stuff out here and aren't really looking forward this far. But as time goes by, we'll need more investment there. So there is, if you like, a slowdown in this investment happening. So now I want to talk about the context of the Reserve Bank outlook and this mining outlook. And the first thing I want to explain to you is that these mining booms, they shouldn't be thought of as one thing. They're actually sort of a sequence of various phases that occur. The first phase is the rise in income that you get from the increase in commodity prices. So that actually started from about 2002, as you can see. There's the setback from the global financial crisis. Then we had another big surge, and here we are here. So we're already past the peak in that rise in commodity prices. And from here, we think that that peak will come down. So that's important. Through this period here, this actually represents an increase in Australia's purchasing power, if you like. It's the rise in our commodity prices much faster than the rise of all the prices of goods we imported. So it's like a rise in Australia's purchasing power. So it's built our income. Out here, though, that income growth slows down dramatically because we're not seeing commodity prices rise. In fact, they're falling. So we're going to get an income effect there, which will tend to have a negative effect on the economy. Phase two, the investment boom. So here's the investment boom so far, and there it is peaking in about 2014. The RBA expects that at its peak, investment in mining and energy will be running at about 9% of GDP. We get roughly the same answer as that, but they recently said this in their minutes to their last board meeting, so I've put it on there. After that peak, of course, it looks like investment comes down. The third phase of the mining investment boom, of course, is what we call the extraction phase. And that extraction phase is when we start, all that investment starts paying off in terms of increased exports. Now, through this period from 2002, the exchange rate did what it was supposed to do. It rose as the economy kept expanding and accelerating because of all that investment. Looking ahead, you'd expect the exchange rate to come down, which will cushion the slowing in income growth that I mentioned. It will cushion the effect of moving over from the investment boom, which is quite labour intensive, to the extraction phase, which is less labour intensive. I've seen estimates that say, in some of those liquefied natural gas plants, for every 10 people they employ in building it, they'll only need one when it's operating. So all that employment that's been generated will drop away as well. So what does that mean for the Reserve Bank? Well, one of the issues here is it depends on what happens to the exchange rate. This is the recent history of the iron ore price, Australia's largest mineral export. The iron ore price, of course, like everything else I've showed you, rose quite rapidly, peaked out up here. Now, excuse me, it's come down, and we had this terrible fall in the iron ore price recently, which has just bounced back a little bit. Meanwhile, the trade-weighted index of the Australian dollar remains stubbornly high. So here's our synopsis for the Reserve Bank. Unless that exchange rate comes down, the Reserve Bank is going to need to cut interest rates. Now, in saying that, I'm not saying that because I think they're silly enough to try and make this currency come down. I'm going to explain to you in a minute why I think this currency is high. But for the moment, we think it will stay relatively high, and there isn't much the Reserve Bank can do about that. But what it can do is it can offset the brakes that high exchange rate put on the economy by boosting growth through lower interest rates, and we think they're about to do that. So we've changed our forecast recently, and it's important to understand why, because we're not saying at the moment the economy is weak. We're saying monetary policy takes a good 12 months at least to work. They're focused out there gazing into the distance 12 months ahead when the investment boom's over, and realising that with a high exchange rate, other parts of the economy need to pick up the slack, and therefore lower interest rates are going to be needed to keep the rest of the economy bubbling along to take up that slack. So it's very much sort of looking way out there into the future. Now, there's been a lot of releases from the Reserve Bank in the last month, one way or another, that have focused on this particular issue. We think that's a warning that they're now thinking the exchange rate stayed too high for too long and they're going to cut interest rates. So we've got two more 25 basis points, 50 in total, excuse me, cuts in interest rates over the next while. Notionally, we've got them in November and February. To be quite frank with you, I wouldn't be at all surprised to see an interest rate cut in October now. The market has about more than 70% of an interest rate cut already priced in. I think all of the economic editors from the major financial press in Australia have been talking about rate cuts. It certainly couldn't be said it would be unexpected. I think they might just take the opportunity in October to do it. If they don't do it in October, we think they'll come and do it in November. Now, before I finish, I wanted to talk about the Australian dollar. I'm sorry for you people up the back there. I know you won't be able to see these numbers, so I'll try and explain what this means in a few words. So basically, this is an explanation of why the currency is overvalued. And I might jump before I come back to that and show you that it is overvalued. So the two red lines here represent what we call the fair value range from the Australian dollar. That's calculated with reference to interest rates, commodity prices, and something we call the global appetite for risk. So that's basically about mood swings of investors. And this is an econometric model, and the model has done very well at tracking the Australian dollar through all this period, up to about the middle of 2011. At that point, you can see that the currency is persistently tracking above our fair value range. Now, we think the reason for it is because overseas central banks and sovereign wealth funds have been buying our bond market, our Commonwealth government bond market, and they've also been buying the state government bond markets. And the reason why they've been doing that is because they see that as a very good investment. Why do they see it as a good investment? Well, because Australia is only one of 7 countries, that you can see down the side here, that now has a AAA credit rating from all of the rating agencies, Standard & Poor's, Moody's and Fitch. So those 7 countries are Australia, Norway, Canada, Sweden, Singapore, Denmark and Switzerland. You'll also note that, for example, for a 5-year bond, in Australia you can get 2.7%, in Norway you can get 1.3%, Sweden will give you 1.1%, Singapore will give you 0.4%, or the Swiss will give you nothing if you want to give them your money. Right? So when you think about it, Australia is one of what we call the Magnificent Seven, the 7 countries with a AAA credit rating, and we've got the highest yield. And that, in a nutshell, I think explains this overvaluation you can see here.